Welcome to today's lecture where we dive deep into one of the most important areas in bank risk management, credit risk measurement and credit rating. Now, before we get into models and technicalities, let's understand the basic idea. Every time a bank gives out a loan, it's taking a risk, the risk that the borrower might not repay. This is credit risk. Measuring credit risk is not about guessing or making assumptions. It's about estimating how much loss the bank might suffer if some borrowers fail to repay, and then planning accordingly. We usually talk about two types of losses here: expected and unexpected losses. Expected loss is the kind of default you anticipate based on past data. Unexpected loss, on the other hand, is the extra loss that can happen over and above what you expected, something that often surprises even the best risk managers. So how do banks go about this measurement? The answer lies in data. Banks study the performance of similar types of borrowers over a period, ideally 5 years or more. For example, they might look at the repayment behavior of small business loans, or housing loans, or MSME borrowers, grouped into categories. By tracking how many of those loans turned into defaults over the years, banks start getting a pattern. These patterns help them estimate what percentage of borrowers from a particular group are likely to default, and how much the bank might lose on average. And this is not just for bookkeeping. These numbers are vital. They feed directly into the bank's pricing models, capital planning, and risk strategy. Now you might ask, how does credit rating fit into all this? Credit rating is simply a tool to categorize borrowers based on their creditworthiness. When a bank assigns a credit rating to a borrower, it's essentially predicting, will this borrower repay reliably or not? The idea is to convert all the complex financial, business, and market information about the borrower into a simple rating grade, like A, B, C, where A implies low risk and C implies higher risk. This makes it easier for the bank to compare borrowers and make decisions efficiently. So what goes into this rating? Banks look at multiple angles. The first and most obvious one is the borrower's financial strength. Are they profitable? Do they have enough cash flow to meet obligations? How leveraged are they? In other words, how much debt are they carrying compared to their equity? But finance alone doesn't paint the whole picture. A strong balance sheet today can turn weak tomorrow if the management is poor. That's why the quality of the management team is also evaluated. Is the promoter experienced? Have they faced any governance issues or defaults in the past? What's their track record in crisis? Then comes the environment in which the borrower operates, the industry. Some industries are more volatile than others. For example, a borrower in real estate may face more ups and downs than someone in FMCG. So the health of the industry, the level of competition, and regulatory risks all matter. Lastly, the specific business strategy of the borrower is assessed. Is it a small local player or a company with national reach? Does it have a reliable customer base? Are its supply chains and operations stable? All of these factors together influence the credit rating. Now, let's deal with a common doubt. What if a borrower rated a default? Or a borrower rated C performs very well? Yes, individual exceptions will always exist. But credit rating works at the portfolio level, not for predicting the behavior of one borrower, but for understanding the behavior of groups of borrowers. Suppose a bank has 100 borrowers rated A and 100 rated C. Over time, the bank might observe that only 1 or 2 of the A-rated borrowers default, while 10 to 15 of the C-rated borrowers fail to repay. That's a clear pattern. The group behavior is predictable even if individuals vary. This predictability is what makes credit scoring models so useful. Now you might wonder, apart from risk assessment, how does this rating help the bank practically? One major benefit is in pricing loans. A borrower with a higher probability of default naturally carries higher risk. The bank compensates for this by charging a higher interest rate. Let's say a bank knows that out of 400 B-rated borrowers, 5% typically default. That's 20 potential losses. But out of 200 A-rated borrowers, only 1% default, that's just 2 cases. So the bank will charge a higher rate to B-rated borrowers to cover this higher expected loss. This concept is called risk-reward parity: more risk, more reward, or at least, more protection for the lender. Beyond individual loans, credit ratings are crucial for managing the entire credit portfolio. If a bank knows how many borrowers fall into each rating category, and it knows the historical default rate for each category, it can plan how much capital is needed to cover expected losses, how much buffer is needed for unexpected losses, what returns it can expect from the portfolio. It can even simulate stress scenarios, like, what happens if economic conditions worsen and default rates rise? This kind of planning helps the bank meet regulatory requirements and maintain stability during tough times. Now, before we conclude, let's not forget the regulatory framework. The Reserve Bank of India mandates that banks must adopt internal credit rating systems. This means banks need to categorize all their borrowers using a scientific method, maintain proper default data, and use that information in capital and risk management. This is part of aligning Indian banking practices with international standards under Basel guidelines. To summarize, credit risk measurement is not just about identifying whether a borrower will default, but about quantifying the loss and preparing for it. Credit ratings help in that process, from assessing risk, to pricing loans, to capital planning and meeting RBI norms. This is why every CAIIB aspirant, and every banker, must understand how ratings work, how data drives decisions, and how risk becomes measurable through smart models. If this lecture helped you grasp the topic clearly, don't forget to give it a thumbs up and share it with your fellow CAIIB aspirants. Subscribe to CAIIB Guru for more in-depth lectures, exam strategies, and real banking insights. Got any questions or want a specific topic covered next? Let me know in the comments. See you in the next class. Until then, keep learning and stay consistent in your preparation.